Welcome back once again. In our previous video, we would have looked at our receipts and payment account for this nonprofit organization called Mambo. And we would have started to discuss our step 3, where we are going to be calculating the missing figure. And we said in that previous video that we cannot use the control accounts to calculate the missing figure on its own. We can't just come up with the control account, but I am going to demonstrate how I'm going to use this control account to come up with some of my missing figures. But remember, we stated that when more than one figure is missing from the control account, you cannot easily ascertain the information, and you will have to go through using your markup or margin that has been provided. So in this question, let me demonstrate and show you what I'm referring to with respect to the control account. In this question, we are given our opening bar suppliers or our bar creditors of $4,900. So let's put that in. That is our balance brought down. So our balance brought down for our bar suppliers, $4,900. We also know how much we paid the bar suppliers. We know it's right here in the receipts and payment account. Payments bar suppliers, $16,049. So we can enter that as well. And that will be called bank, because all the transactions were done through the bank account. That is $16,049. We also know, based on the question, let's go back to the question here. We also know, based on the question, that they stated here in additional information note number 1 that $800 in cash discounts were granted by the suppliers. So if the suppliers grant Mambo a discount, it means that Mambo receive a discount from his suppliers of $800. So we can enter that inside of the account as well as a discounts received, and that is $800. What else do we know with respect to this particular question here? What else do we know? We go in note number 3. It says Mambo returned $402 in bar supplies. So we have a return outwards. So Mambo is returning bar supplies to the creditors. So you have returns outwards of $402. Now, what it is that we don't know. Based on the question here, we do not know the closing balance for Mambo in terms of creditors. We don't know how much this organization owes the creditors at the end of the period. So we can come here and we say balance carry down. We don't know what that is. So let's put a question mark there for the time being, because we don't know what that figure is. So we put a question mark for the time being. Another thing we don't know would be our purchases. So that's another question mark there as well, because we don't know the purchases. So we can put a question mark there. So this is why I'm saying to you that at this stage, the control account cannot be used to ascertain purchases and balance carry down at the same time, because there are 2 figures that are missing. It must be only one figure missing in order to ascertain a missing figure. So this is why the control account is not appropriate at this time. And if we go back to the question stated in note number 4, the organization normally applies a 25% markup on all the bar supplies that are to be sold. Not sold, but to be sold. In other words, on the cost of the goods that they are selling, they are applying a 25% markup. However, we don't know that cost because markup is associated, based on our previous explanation of this concept, markup is associated with cost of sales or cost price. But what we know in this question is our sales. We know the bar takings. We know that sales are $98,200. So what we can do is that we can take our markup and convert it to a margin so that we can work out what our gross profit is, and then we can use those figures along with other figures to work out our purchases. Okay, so let's look at converting our markup to a margin and then going from there to work out other figures. So let's look at that. So we know that our markup is 25%. So markup equals 25%. So what we're going to do is to convert this markup to a margin. So markup is 25%. So what is margin? And last time we would have stated how to convert to margin. So we are converting the markup to the margin by taking the same 25% that they would have given us, and that is over out of 100. So 25% out of 100 plus the 25%. So again, that is how we are converting from our markup to margin. So when you're converting from markup to margin, you add. You take the percentage that they give you and add it to the 100 at the bottom here. So that would give you 120. That would give you 125. So that would end up being then that your fraction would be 25 out of 125. Okay, so that's how you convert from markup to margin. If you want to convert from margin to markup, you would do the opposite. Instead of adding at the bottom, you would subtract. So to convert our markup to margin, we are going to add. So when we take our 25 and add it to the 100, we get 125. So 25 divided by 125 give us 1/5. And if we multiply that by 100, it would give us 20%. So our margin is 20%. So now we know margin is 20%. Let's calculate our gross profit, because this margin now is 20% of our sales, because margin is associated with our sales. So this is 20% of our sales will give us our gross profit. So our gross profit would then be, what is our sales figure? We look at our sales figure. In the question, sales is $98,200. So that would be 98,200 multiplied by 20%. So 98,200. That gives us gross profit of $19,640. So now we know our gross profit is $19,640. So then, since we know gross profit and since we know sales, we can work out our cost of sales, our cost of goods sold. And let me tell you how we are coming up with these things. Now, your sales minus your cost of goods sold will give you gross profit. So sales minus cost of goods sold gives you gross profit. So it stands to reason that if I'm subtracting my cost of goods sold or cost of sales from my sales and I get gross profit, then if I subtract my gross profit from my sales, I should get my cost of goods sold. So sales 98,200 minus my gross profit of $19,640 would give me cost of goods sold. So when we subtract that, that gives us cost of goods sold of $78,560. So our cost of goods sold is $78,560. And remember, in the last series, when we went through the concept of how we arrive at cost of sales in the first place. And we said that your cost of sales, the basic formula would be your opening inventory, add your purchases, minus your closing inventory. It will give you cost of sales. And we said if you have to make any adjustments for your purchases, those adjustments will be included as well. And we took that formula and we transposed it in order to work out our purchases. So let's see how we are going to calculate our purchases now. So purchases would then be equals to our cost of sales. Let me write it here. Purchases equals our cost of sales in this question plus our closing inventory. Plus, and in this question, we have return outwards here, return outwards. So we're going to add our return outwards because that is going to be part of our trading account. Return outwards will be added. And then we're going to subtract our opening inventory. Okay. So that will give us our purchases. So let's look at what our purchases would be now. Our purchases, therefore, cost of sales is $78,560. So $78,560 plus our closing inventory. And our closing inventory here is $3,300. Our opening inventory is $7,150. So our closing inventory, plus $3,300 plus our return outwards. So plus return minus our opening inventory. And our opening inventory, as we stated, is $7,150. So let's look at that. $78,560 plus $3,300 plus $402 minus $7,150 gives us purchases of $75,112. So our purchases are $75,112. So now that we know our purchases, we can go back to our control account and work out what our closing balance for our creditors or our bar suppliers are. So we can plug this figure in here to work out this one here that we didn't know. So we are plugging in one figure that we just worked out, which is our purchases figure. We are plugging that in order to work out what this other missing figure is here. So let's plug it in. And we have our purchases, $75,112. So when our $75,112 is added to our opening balance for our creditors of $4,900, it gives us a total of $80,012. However, on the debit side, the total here is only $17,251. So therefore, $80,012 minus $17,251, and that gives us our closing creditors of $62,761. So you see how we use markup and margin and we come up with our figures. And I will continue in our next video.